We're getting the rate cuts. That's the message from the markets today, tepid though it is as far as the response in stocks. But the dollar is shellacked. So we are going to try to figure out what all is going on here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And as ever, we'll start with what the price action seems to be saying here about what these markets thought today and how they're setting up from here, because we're through the big batch of economic data this week, such as there is economic data. Obviously, we're still very hamstrung by the aftermath of that government shutdown. But nevertheless, so there is some third-party data, some private sector data that we had to look at this week, and now most of it is out of the way. So we begin waiting for the Fed mode. The Fed, of course, gathering next week. The 10th is when we're going to get that announcement next Wednesday. So let's break down what the markets think they know here and why they think this is, for the most part, a good thing, and whether that's really how this will shake out. So another tepid gain for the S&P and the NASDAQ today, relatively moderate, but nevertheless, we do end up on the upside. Looking at the charts here will show you that we're looking at basically a range that has held up. And incidentally, on the close here, these gains were somewhat moderated. I took this screenshot right as the markets had closed, but of course there is the after hours digestion that we get, and looks like the gain in the S&P was 0.34%, gain in the NASDAQ 0.15, so even a little bit more modest than what we have here. Yields go down significantly, off 0.76%, almost let's say give or take 0.75% for the 10-year, almost 0.7% for the 2-year. So the whole curve shifts lower. Crude oil up, gold up, euro up, yen up, Bitcoin up, and up meaningfully enough that we can say it's doing the risk appetite on steroids thing as relative to stocks. So stocks go up, Bitcoin goes up more because it is a less liquid, more speculative reflection of the same risk appetite that seems to be making its way through the stock market here today. What precipitated this? Why are we looking at this picture, which seems to be uniformly of one flavor? That is to say, interest rates in the U.S. lower, dollar lower with them, those things dependent on those narratives uniformly responding. So commodities priced in dollars, higher. Currencies not named the U.S. dollar, higher. Alternatives to the dollar, Bitcoin, higher. Speculative appetite, firmer. Moderately firmer, but firmer. So what is in the offing here? Well, first we get the final results for November's S&P Global PMI numbers that give us a sense of global growth. And the big standouts end up being the European numbers, because there's actually significant revisions here. The Eurozone composite, stronger than expected, 52.8. The UK composite, stronger than expected, 51.2 against expectations of 50.5. Now, as ever, these are in the logic of the PMI math as usual. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see for all the major economies, we're above 50 here. So the global economy is growing. And we'll get to China, of course, in just a second, because that might be something of an exception. But for the most part, the major economies here, Eurozone, growing. Europe, including the UK, growing. But growth in the US slower than initially reported. The first look at these November PMI numbers had us going from 54.6 to 54.8, so accelerating. Actually, turns out we're revised to 54.2. So what's interesting here is, first of all, we're diverging in a direction where the US looks weaker than Europe as far as growth dynamics are concerned. Now, the US is still growing stronger in absolute terms, 54, of course, higher than 51 or 53 almost for Europe. And of course, these are not going to be exactly like for like, but the US certainly still looks like it's growing stronger than Europe in absolute terms. But the path of travel has diverged in Europe's direction in these numbers. Now, that's interesting, of course, because we're not really looking for any more rate cuts out of the ECB all through next year. And the situation in the UK is somewhat circumspect as well, because they have quite an inflation issue there. And so what we're looking at for next year is 2 cuts out of the UK at this point, 41 basis points on the menu for SONIA futures, the equivalent of Fed funds futures for the UK. And that's not nothing. That's something like 1 cut at least, and about a 50-50 shot at a second. But if we look at how that compares with the outlook after this data here today for the Fed, and indeed where the Fed outlook has stood for a while here, this is the view for 2026, 64 basis points. And that only gets more dovish today. Because if we take a look at what the level of conviction is on December's move, it's only very modestly stronger today. We're at about 89% chance that we're going to get a cut next week, up from 88% yesterday. So hardly any change at all. And a week ago, we were, of course, already north of 80%. So looking at this a week ago, we were looking at 83.5 or so percent. So a month ago, it was a little bit hairier, 66%, 67%. And of course, in that intervening month, from early November through to recently, there was a switch there where Fed policy expectations went to 50-50. That was after Powell's explosive naysaying of rate cut inevitability on October the 29th when the Fed last met. And there was a slide there from over 90% likelihood that you would have a cut in December down to 60-ish, which is what we're seeing here. And then further commentary took it as low as about a 50-50 split. And at one point, actually, a cut looked less likely than standstill by a narrow margin. And of course, what we know of that is that the markets didn't like it, and that the dollar generally held up through it. Because, of course, fewer rate cuts is a good story for the dollar's yield differential position. But what we get here today is a very different kind of a thing. We clearly get a sense that at least US relative to Europe, we're looking more dovish in the US now relative to expectations than elsewhere. Now, I mentioned China here. We get this private sector estimate By the way, it says Rating Dog. That's the new sponsor of the S&P Global's China report. It used to be Caixin. Now it's Rating Dog. But they're still the same S&P Global numbers. For example, in Europe, you can see the sponsor is HCOB. And so when you look at those numbers, they look like nominal growth, 51.2, but that's, of course, down from the prior month of 51.8. And we did get the government's official numbers earlier over the weekend. And both the Rating Dog numbers, which is this in the blue and tends to run a little hotter than the official numbers, and the government's own numbers from CFLP, the China Federation for Logistics and Purchasing, that's essentially an arm of the government. We have this parallel slowdown in China growth dynamics since September, and at least on the official figures, we're in contraction mode. China's economy is shrinking, according to official figures, or at least economic activity in services and manufacturing together is shrinking. The Caixin, or the Rating Dog, former Caixin numbers don't quite show that, but the direction we can see is the same. So for China, the situation still looks dire, but of course they've been in economy-wide deflation going on over 2 years now. And so we're looking at an economy that's basically been hamstrung since before it exited COVID lockdowns and has never really found its legs again. And that continues. But at least as far as Europe is concerned, there is now this appearance of maybe, at least from the dollar's perspective, Europe is trying to take the initiative. Those currencies are trying to take the initiative. Looking at what this looks like for S&P Global U.S. numbers, though, it's not by any stretch a scary story. We're still hovering at a familiar range for overall growth here. And this range generally lines up with the levels that were there in the second half of last year, which, by the way, were multi-year highs, and were there ahead of the tariff scare at the beginning of this year that really took the PMIs sharply lower as people were concerned that they were going to derail the economy. It had to be that on contact with the president's Liberation Day ideas, the markets got, in his parlance, a little yippy. That is to say, the markets dumped the dollar, dumped U.S. stocks, and dumped bonds at the same time for the administration to come back and put a 90-day pause on everything, and then extend that pause where needed to make sure that the actual Liberation Day ideas that the president put forth don't see the light of day in practice, that they essentially end up being an opening bid on negotiations. And once that started to crystallize, of course, first we had the rebound in stock markets. April 7th, 8th, and 9th is where you get that bottom forming, and then you have a rude rally, largely around the idea that this scare has been put in the rear view, as it were, because the administration would not earnestly push it in all of its damaging aspects. We also got the ISM report, and the service sector numbers came in a touch stronger than expected. 52.6 versus 52.1 expected. That's not really a big departure from where we expect it to be. So this is borderline in line with expectations. But when we look at the internals, we see that, especially the Fed relevant bits, employment and inflation, that stagflationary fear that people had in that intervening period from mid-February, let's say, until early April, through the meat of the scare around the tariffs, that stagflationary fear is being realized, albeit very slowly. So we're looking at ongoing contraction in employment for both manufacturing and services. You can see here's that 50 line. The ISM numbers working on the same kind of logic as PMIs generally. So 50 is the center, above 50 growth, below 50 contraction. We can see employment for both sectors is below 50, and that is, it is contracting and has been for a few months now. In the case of manufacturing, it's been contracting all year. While the prices structure has cooled a little, but still looks very elevated. Here's the beginning of the year here. As you get the tariff scare, you've shed a lot of that scare on the manufacturing side. You've not really made a big dent on the service sector side, although you get a decent dip in this most recent set of data. But you still have a situation where growth in employment appears to be souring, but the price structure appears to be still relatively heady. Now, from the Fed's perspective, they, of course, have been looking at this. And the message that we got in September and again in October is that these are maintenance cuts that we're seeing designed to backstop what's going on right here. And to that end, we got the ADP gauge of private sector payrolls here with a 32K decline in private sector jobs in November against expectations for a very meager 10K rise. So we're looking at a situation here where ostensibly the Fed's logic for a rate cut holds and policy expectations reflect as such. But as we just said, this isn't really materially different from where it was a week ago, from where it was even very recently. And so this is, for the most part, seemingly priced in. What isn't priced in is, once again, this picture, because not priced in the sense that the markets and the Fed are still very much at odds. Now, one of them is going to have to shift. Maybe it's the Fed. Because when we look at September's summary of economic projections, what we find is that the Fed only has one rate cut on the menu for next year, from 3.6, which would be 3 cuts this year, as now the markets wholly expect is going to be realized. And from 3.6 to 3.4, that's rounded up 1 cut. And what the markets have is 64 basis points, which is at least 2 cuts. That would be 50 basis points, and 14 basis points in the direction of a third one, which amount to better than 50-50 odds that we are going to get that third cut. In fact, 56% chance to be exact. And that, of course, is at least a cut, maybe 2 cuts off from where the Fed is. And so the risk at this point, where the Fed might well disappoint the markets, isn't in the cut that's coming almost assuredly next week. It is in what they write down in the new summary of economic projections. And the bargain between the two sides of the committee, we of course have heard now repeatedly, including from the FOMC minutes from October, that there is a vast chasm on the committee and a vigorous debate as to whether it makes sense to press on with easing in the absence of critical economic data and thereby in the absence of visibility into the economy and what's actually needed for policy. And so you get the camp that thinks, okay, we'll cut in December, but we need to be very slow going and take it meeting by meeting and not overpromise because we might underdeliver if inflation gets haywire, and then the markets are going to freak out. And then there's the camp, we'll lovingly call it the Stephen Mirren camp, which has never met a rate cut that they didn't like. And that, to some extent, of course, reflects the consensus of the administration. Stephen Mirren, after all, basically on loan as a Fed governor, having been the chairman of the Council of Economic Advisors to the president, and never left that role, despite the supposed respect that the administration has and that Stephen Mirren has for Fed independence. He's essentially on a leave of absence from the White House, and it tends to return. So make of that what you will, but that dovish camp clearly wants this third cut at minimum. And so maybe what the bargain ends up looking like, because the Fed is, after all, a consensus-driven organization, people vote. The chairman doesn't get to just decide things. Maybe the consensus ends up being, look, here's your cut for December, but we're not moving the summary of economic projections. We're leaving it at one cut. And we'll update it as need be. If that ends up being what we see, the markets aren't going to like it, most likely. And we see here that since that October 29th meeting, where Chair Powell so forcefully pushed against the inevitability of incoming cuts, that's where stocks top and come down. They've since rebounded to basically the starting line here, to where that move occurred, a little bit lower than the high, but just after this digestive period where the markets took on the Fed and tech earnings and then decided they don't care so much about the tech earnings, they care about the Fed, and resolved lower. We've basically returned back to that level here, and we're waiting for the Fed announcement. Clearly, the markets want the easing. If the promise of easing doesn't come, they may well resolve back down again. For the dollar, we can see this has been a rough ride since we've stopped this adjustment post-Fed meeting, and it's corrected meaningfully lower. It's not unlikely that risk sentiment firming up has been a part of this move. But again, if it looks like the Fed is more reluctant to cut next year than the markets think they ought to be, we probably get a forceful dollar rebound. As far as positioning is concerned, I haven't changed very much here in my exposure. Still long gold. That's working. Clearly, the dollar isn't working today. I'm still long the dollar via being short the Aussie, the pound, and the euro. Obviously, all of those currencies having strong gains today. So that's in the minus column for me today. But I'm still holding those positions. I don't think we've crossed any red lines here. And so we'll see what happens in the run-up to the Fed. Bitcoin up today. I'm still a little bit short here, having taken the bulk of the position off early in the week. But we'll see what happens from here. At this point, the sort of risk on, risk off dynamic has basically become will they, won't they dynamic on Fed dovishness. And ultimately, if the perspective is that the Fed might not arrive at where the markets wanted to arrive, you probably resolve lower on risk and higher on the dollar. And since that is what I'm suspecting here, I'm long the dollar. I'm still short risk, so still short a bit of Bitcoin. Still have the puts in S&P. They're still moderately in profit against all odds because I took them on Fed Day, October the 29th. So I'm holding on to this to see if this is going to ultimately extrapolate further lower, still long a bit of silver, and long the bonds, which is working today. Still a little bit short crude, which basically is just oscillating at this point. The trend has been down, but today is an up day, and I've got 16 days to expiration to figure out whether I want to keep this thing or not, and we shall see. And besides that, still have my longer term exposure to Brazil, where I've took profit on half earlier in the week and now have added back in, and MSOS on the possibility. This is a very long-term position, obviously, looking all the way out to January of 2027, for the possibility that cannabis descheduling comes up in the midterms next year. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go there from. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.